Okay, good morning everyone. We are from Group 1. So today we're gonna present about foreign exchange market. And this is the learning objective. Before we get started, let me introduce myself. I'm Bintang Nadhiva with Dorothy, lead of MPMS or training. And I'm here with my partner, Yuki Fairuuz, with Dorothy, lead of MPMS or the Bintang one. So the foreign exchange market or forex market is a global network that allows companies and individuals to exchange currency. This is essential because international business involves transactions across countries with different currencies. Why is it needed? Different countries use different currency, so companies need to exchange their home currency to transact abroad. Imagine a Brazilian company wanting to buy supplies from Japan. They can pay in Brazilian reals, so they need to exchange it for Japanese yen to complete the purchase. The forex market facilitates this exchange. So there are three types of foreign exchange transaction. The first one is spot transaction. This is the most common type where currency are exchanged immediately at an agreed upon rate. Banks typically settle this transaction within 2 business days. The exchange rate reported in the media are usually spot rates, often for large transaction, example $1 million or more. The second one is forward transaction, ideal for businesses that need a specific amount of foreign currency at the future date. Companies can contract with a bank to buy currency at the predetermined exchange rate on the specific future date. This protects them from potential fluctuation in the exchange rate between now and the purchase date. And the last one is currency swap or exchanging and swapping back, primarily used by banks to manage their foreign currency reserve. Two banks agree to exchange currency at a set rate, then swap them back at a future date, also at a predetermined rate. This helps banks ensure they have enough of a particular currency to meet customer demand. So there is a variety of rules that country can use to govern the value of their currency relative to the value of other nation currency. These rules are called the exchange rate system. Historically, there have been three major exchange rate systems. The first one is the gold standard, the Bretton Woods system, and the other currency exchange rate system. So the first one is the gold standard. The gold standard was a monetary system used the mid 18th to the 1830s. Here's how it worked. Currency were valued against gold. Each country fixed their currency value to a specific amount of gold. Guarantee exchange. Government promised to exchange their currency for gold at this fixed rate. The next one is stable exchange rates. Since all currency were tied to gold, exchange rate between countries become more stable. So the end of the gold standard, the first one is when World War One disruption. European nations stopped convertibility of currency to gold during the war. The next one is post-war struggle. Post-war economies didn't fit the pre-war gold values, leading to instability. The last one is focus on employment. Government prioritized employment over maintaining a fixed exchange rate. The next one is the Bretton Woods Agreement. Following World War II, countries needed a stable system for international trade. This led to the Bretton Woods Agreement in 1944. Rigid exchange rates. Countries fix their currency to the US dollar, which is turned was tied to gold at $35 per ounce. This created a system of relatively stable exchange rate. International Monetary Fund, or IMF, the agreement established the IMF to help manage international monetary cooperation and oversee the page exchange rate system. And the other currency exchange rate system, the first one is managed float. Countries can intervene in the foreign exchange market to influence their currency value. This is a compromise between a completely free float and a fixed page. And the next one is crawling page system, a variation of the fixed page system that allows for small adjustment in the exchange rate over time. This helps account for gradual change in economic condition. The next one is a country page. It's currency to a basket of several other currencies, not just one. This spread the risk and reflects trade relationship with multiple countries. And the last one is dollarization. A country adopts the currency from another country, often the US dollar. This eliminates exchange rate risk and potentially reduce inflation, but can limit control over monetary policy. So the next one is what determines exchange rate. The first one is purchasing power parity or triple P. This theory suggests that similar goods in different countries should cost roughly the same when exchange rates are factored in. Depreciation or triple P occurred too, leading to currency being considered overvalued or undervalued. The next one is market factor. Supply and demand play a major role when there is a strong desire to buy a country goods, services, and investment. Its currency becomes more in demand, driving its price or exchange rate up. Conversely, a decrease in demand weaken the currency. So the next one is the other factor. The first one is inflation. Higher inflation in a country can make its currency less valuable compared to countries with lower inflation. And the next one is interest rate. Investors are attracted to currency with higher interest rate, increasing demand for that currency. The next one is income level. Rising income level in a country can lead to increased import, boosting demand for the trading partner currency. The last one is government control. Government can use tools like tariff or currency intervention to influence exchange rate. Tariff or taxes on import discourage foreign goods, reducing demand for the foreign currency. Conversely, buying foreign currency directly increase their demand and strengthen their value.
Okay, so I will explain about the exchange rate risks and hedging. So exchange rate fluctuations create risk for businesses operating internationally, and these risks can be managed through hedging techniques. And in this part, we have three parts. So the first one is types of exchange rate risks. The second one is hedging, and the last one is choosing for a hedging method. So I will explain first about the types of exchange rate risks. So it has two types. The first type is transaction exposure. Transaction exposure occurs when a company agrees to a future transaction in a foreign currency, and fluctuations can impact the final cost or revenue. And the next type is the translation exposure, arises from valuing foreign assets and liabilities in the home currency, and changes in the exchange rate affect the company's overall financial picture. Okay, and now here I will explain about the hedging. Hedging helps businesses manage exchange rate risk and protect the profitability in the international market. And the companies use hedging to make future exchange rates more predictable. And here are some methods that use in hedging. The first one is forward contracts. Forward contracts is agreeing on an exchange rate today to buy a currency at a specific future date. And the next one is the currency futures contract, similar to forward contracts, but traded on a regulated exchange with standardized terms. And the last one is the currency futures contract, buying the right but not the obligation to buy a currency at a certain price by a certain date. And this protects against unfavorable rate movements. And the next one is choosing a hedging method. We have three methods that we can choose. The first one is the forward contracts. Forward contracts is suitable for large companies with specific needs and negotiated with banks. And the future contracts. Future contracts is preferred by smaller companies due to the standardization and ease for access. And also we can option for hedging, used when companies have a strong forecast or future exchange rates. Okay, and then I will explain about the foreign exchange arbitrage. It is making money by buying low and selling higher priced currency, and this is called foreign exchange arbitrage. And the opportunity for this is when exchange rate differs slightly between markets, for example, like New York versus Tokyo, an arbitrage opportunity is exist, and buy the currency in the market with lower exchange rate or more currency per dollar, and sell the currency in the market with higher exchange rate or more dollars per currency. So for the case, we have two cases. The first case is impact of strong US dollar on Apple and Microsoft. In recent years, the US Federal Reserve, or the central banking system of the United States, has been pushing for aggressive interest rate increases in response to rising inflation with the goal of stabilizing the economy. However, these actions have unintentionally led to the strengthening of the US dollar, causing major problems for multinational firms such as Apple and Microsoft, and who rely on significantly international markets for their revenue. As the US dollar rises in the value, the purchasing power of foreign currencies falls, and making American items more expensive for consumers in other countries. And this has caused corporations such as Apple to raise the product pricing in regions like Japan, where the local currency has depreciated against the dollar. For example, the iPhone 13 price increased by 19% in Japan as the value of the yen fell. And the impact on the Apple's competitiveness in foreign markets may suffer due to price increases, perhaps resulting in lower sales and income. And Apple Chief Financial Officer, M.S.i, acknowledged the negative impact of the stronger dollar on the company's revenue growth, and anticipating an approximately 300 basis point headwind to year-over-year growth due to currency fluctuations. And the impact for the Microsoft is the currency changes have reduced Microsoft's revenue and profit projections for the fourth fiscal quarter. And the strength of the US dollar has reduced the value of foreign revenues for American multinational corporations and making their products less competitive in regions with weak currencies.
Okay, so this is the case that I choose target strategic mistake in the Canadian market. In 2023, Target Corporation, one of the largest retailers in the United States, embarked on an ambitious expansion into Canada. The move was seen as a natural progression for the retail giant, aiming to tap into the Canadian market's potential. Ultimately, this issue culminated in Target's decision to exit the Canada market in 2015, closing all of its 133 stores and leaving behind billions in losses. Target acquired the leasehold of 220 Zellers locations from the Hudson Bay Company, intending to convert them into Target stores. The company planned to open over 100 stores across Canada within a year, a a rapid expansion strategy that was unprecedented for the retailer. So there are actually financial impact and foreign exchange consideration. The first one is the financial performance of target Canada was directly affected by the exchange rate volatility, which influenced the cost of importing goods and pricing of products. Currency fluctuation also affected the conversion of Canadian revenue and profit back into US dollar for financial reporting, exacerbating the apparent financial distress. And the last one is target inability to establish a profitable operation in Canada, coupled with the foreign exchange losses, led to a significant financial blow for the corporation. So the conclusion is target withdrawal from Canada and the impact of US Federal Reserve policies on M.S.i like Apple and Microsoft highlight the importance of foreign exchange market in international business. Companies must understand local consumer behavior, adapt to diverse market conditions, and manage currency risk. A comprehensive strategy, including supply chain management, local market adaptation, and financial risk mitigation, is crucial. These cases highlight the complexity of global expansion and the profound effect of domestic economic policy on international market operation. That's all from us. Thank you for your attention. See you next time.